Good evening, students. Welcome back. So today we are starting with a new tab chapter. I'll just share the document. Chapter 4. Okay. So this chapter is all about materiality, risk assessment, internal control. I would say an extremely important area as far as audit of financial statements are concerned. Further, if you look at the requirements of this topic, this is also, in a way, you can say, a part of the planning process. So we discussed about certain stages of audit, wherein we talked about that planning also happens to be one of the stages there. Now, in relation to those stages, planning we have been discussing is a critical stage. Now, as far as that planning is concerned, you can say within that planning, very important requirement, or you can say a very important section as far as planning is concerned, happens to be the risk assessment and internal control. Okay. Now, what is this materiality? What is this risk assessment? What is this internal control? Before we get on to that discussion, I think first of all, we will have to understand what is it that we are trying to cover in relation to the audit. Okay. Or in a way, we can say that it will be helpful to first of all get an understanding of what this audit risk is, what this internal control is, and then we'll get into the technicality and some of the components, evaluation of all of these elements one by one. Right? Now, let's talk about audit planning. Okay, so what I'll do is I'll just take you back to the audit planning. So say now the audit is required to be performed. Let's suppose that's the situation. Right? Audit is required to be performed. And there's a team planning. So this meeting has to happen in relation to the planning of the audit. So the team will have to meet. So team will have to plan that entirely. Now, in this case, let's suppose engagement team has, let's suppose 5 persons, right? So this is the engagement team. And we are looking at the financial statements of ABC Limited. Okay, and for the financial year 25-26, audit is required to be formed. So as we understand, generally, when do you start the planning? You don't do that once the financial statements are already prepared. Okay, so before the year end, it's better planning process actually. So that's why we can say that we are at a stage when this planning is generally performed by most of the engagement teams. Now, as part of this planning, what do we do? Yes, we'll have to think about it. Yes or no? So when you say planning will have to be done, so that comes the question that what do you mean by planning? What is required to be done in case of planning? So in a very broad manner, we can say this engagement team will be looking at the audit procedures. Yes or no? That's the plan they will have to do. So they will have to think about the audit procedures they will have to perform. Okay. Now, for the audit procedures to be performed, what do they need? They need the understanding of the entity. They need the understanding of the processes. Why? Because any areas which are there in relation to the financial statements, if those are required to be audited? How do you go audit them? You'll have to understand that. Yes or no? Because till the time you don't understand, how do you go and check that? How do you examine? What do you verify? Will you be able to verify anything? Answer is no. Now let's suppose entity has a draft set of financial statements. Okay. Let's suppose this is the draft set they have prepared. Now, what is going to be the objective of the auditor? They will have to assess any misstatements, any material misstatements there. Okay. And for that to be looked at, for that to be understood, what do they need? They need to know any errors which are possible. Yes or no? Or you can say the possible misstatements. Correct? Now, how do you identify that? There comes the question. Can you just flip through the financial statements and identify that? Answer is no. And that is where we have discussed auditor will have to get into the processes. Yes or no? So he will pick up, let's suppose, sales process. He will pick up procurement process. Let's suppose he will pick up payroll process. Right? Some of these processes auditor will pick up. And he will try to get into the details of that. Means he will obtain an understanding of all of these processes. Now, within the process, let's suppose if you talk about procurement, there will be various activities. A1, A2, A3, so on. Various activities would be there, various transactions must be there. So the flow of transactions, you will have to understand. Same thing will go on for sales. Same thing will be there for payroll. Correct? Now, while understanding this, one important aspect which the auditor will want to understand is that if, let's suppose, so many activities are involved, so many procedures are involved, there's a flow of transaction. So somewhere within that flow, somewhere in relation to any activity, any transaction, what if there is an error? What if there is a problem? Possible. So we are not talking about intentional one. Let's forget about intentional one. Within a particular process, there is a possibility that something may go wrong. Yeah. Because will it be correct to say that in the entire process, throughout the year, nothing will go wrong or nothing may go wrong? It may happen that nothing goes wrong, but it may go wrong. What if that goes wrong? Will it have any financial impact? If yes, then what will happen? That's when we'll have a problem. Why? Because all of these things will flow down to the financial statements. Yes or no? Yes or no? So therefore, one point which we understand is that as far as all of these processes are concerned, okay, three are the ones which I have listed down. Definitely, there are various other processes. And of course, these are not limited to only three. Something may go wrong. And that's what the auditor will want to understand. Or we can say that auditor will want to understand what can go wrong. He will want to understand. Now, this, what can go wrong? Don't you think that the management would have also thought about it? Because it will not happen that only if the auditor is coming, so the auditor, also the management will think about it. No, management must have already thought about it. Why? Because it's their business, it's their company. They want to run their company in an effective manner, they want to run the operations in an effective manner. So, how is that possible? That's only possible when the management would have identified this. Correct. That's where it becomes important on the part of the auditor to understand what can go wrong in relation to various activities. Now comes the question that how does it help the auditor? See, this helps. Why? Because if the auditor will understand that there are few areas, there are few items wherein there are a chances that something may go wrong. So what do you call it as? That's what you call as a risk, isn't it? That is actually a risk. So the auditor will have to identify that. And is it something which is driven by the auditor? No. Before the audit, management must have already done that. Auditor is only trying to check what the management has already done. And if there is anything which the management has missed out on, that's what the auditor would want to look into. Yes or no? That's the part of audit. That's the process of audit. Actually, this is how the audit is performed. Correct? Now, in this case, sometimes a question may arise that in relation to any process, what is it that may go wrong? Let's think about it. So I think we can take a very simple example for this. Okay. Let's suppose we are talking about payroll, right? Now, in relation to payroll, it may happen that while processing the salary for employee PQR, bank details are wrongly picked up. What will happen? Salary will not get credited to the employee. Is that a risk? Answer is yes. Now, does it mean that if such risk exists, so every time there will be a wrong credit of error, or every time there will be a wrong posting of the payroll amount or processing of the payroll amount in an erroneous manner every time? Answer is no. But there are chances that something like this can happen. Correct? There are chances around that. And what is the audit objective? Audit objective is to get into all of such risks. Now, let's talk about a situation. Let's suppose management has also done this assessment. Okay. Let's suppose auditor goes to the management, asks for the processes, asks for the understanding of all of these things. And the management says, no, don't worry, we have already identified that. Okay, we have already taken care of that. Now, how do you think the management could have already taken care of that? Any thoughts? Any thoughts? How do you think this could have been taken care of by the management? Saminathan, if you are around, would you like to answer this? How do you think this could have been taken care of by the management? What are the ways through which this could have been taken care of by the management? Tell me. Great. Saminathan says through internal audit, Okay, or maybe there is an internal check system. Then there is a concept of maker checker, right? Now, all of these examples which you are using, actually, there's a terminology for that. What is that? Actually, we are talking about internal controls, isn't it? We are talking about internal controls. Now, what are internal controls? And why do we call them as internal controls? Because these are internal to the company. These are the one which belong to the management. These are the ones which belong to the management. Okay. And in relation to such internal controls, another important part which the auditor will have to understand is that as against these risks, means against such what could go wrong, what is it that the management has done? Means how did the management mitigate that? What is it that the management has done to mitigate that? Yes or no? Because if the management has taken care of that, how will that become possible? That will become possible by setting up internal controls. Let's suppose if we continue on an example. Let's suppose there was a risk that the salary of PQR is credited to wrong bank account. Okay. Say the management says that before processing any salary and at the time of updation of bank account, what do? One person will verify that whether the bank details of the employee are correct or not when those are uploaded in the system, and those remain fixed. Okay, so those are not changed every now and then until unless there's a change in the bank details of the employee. Further, management says that on a regular basis these details are also verified. Now, by setting up these two activities, what is it the management has done? Management has actually tried to mitigate this risk. Correct? So that's what the management has tried to achieve, and this is what you call as internal controls. So, who has the responsibility of these internal controls? Is it the auditor? Answer is no. Answer is no. It's the responsibility of the company. Okay. Company will not only identify these, company will also be required to set up these internal controls. Correct. And that's what you call as internal control system in a way. Okay, so effectively a system is set up. And hopefully you would have now understood that such a system is important for the functioning of the company. So without that, should we say that the company will not be able to function? No, it's not that the company will not be able to function, but for its effective functioning, for a situation wherein the activities are going on with lesser chances of error, this internal control system becomes important. Yes or no? And now, what is the role of auditor here? The role of the auditor is to understand both of these and to evaluate these as to whether these are appropriate, these are sufficient or not. If there are any gaps, that again needs to be evaluated in terms of its impact on the financial statements. Clear? Yeah. Now comes another point that let's suppose internal controls are understood, a system is also understood. But what if the management has set up some controls? And what if nobody is following that? Possible or not? Say the management has set up a system, but nobody is following that. So that's where two things become important for the auditor to look into. See, one is the design. Now, what do you mean by design? Design means to put across a policy, to put across a document. Means something is laid down, that this is how things are required to be done. You can say it's effectively a document which has been put down. Is this important? No doubt this is important. And then comes another part, which is called as implementation. Now, what do you mean by implementation? Implementation means application of these controls. Means whether these controls are being applied or not, whether these are operational or not, and whether these are operational in an effective manner or not. Because a document which is just prepared for the sake of having a document, but which is not applied, okay, which is not implemented, is of no use. Yes or no? That's of no use. That doesn't help the process. Okay, so that's why it's important to have the implementation alongside. Right? So only the design is not important, or you can say sufficient. Both of them are required to be in place. And both of these things, you can say, is what the auditor will have to get into. This is what the auditor will have to evaluate. Clear? Yeah. So the idea was to just give you an understanding, a background of what this risk is all about. What is this? What could go wrong? And of course, this internal control broadly, though there are a lot of you can say ingredients around it. As of now, we have just touched upon this point, but any questions, any doubts if you have before we move further? Saminathan, any question? No? Sure. Great. Very good. Now we will move further on this audit risk part. See, audit risk, risk assessment, or this internal control, I'm sure if you know about it, this is very important from examination perspective also. So let's talk about audit risk. Now, what are the components therein? So if you look at this, I think picture, it talks about three types of risks: inherent risk, control risk, and detection risk. So we'll understand all of these risks one by one in detail. But why do we have all of these risks over here? And what do we do in respect of all of these risks. Okay, so let's try to understand. See, for the purposes of assessment of the auditor, you can say there's a mathematical exercise. Okay, it's not really calculation as such, but you can say there is something which you call as audit risk. There is a term which is called as audit risk, which is actually comprising of what? Inherent risk, control risk, and detection risk. Audit risk, we can say, can be broadly categorized into two parts, or you can say it has got two components. What is the first one? Now we are not talking about the financial statements, please. We are talking about the risk which the auditor will have. Okay. Now, what is the first one? Risk that the financial statements contain material misstatement prior to audit. So where does it originate from? It originates from the company. Should the auditor be considering such risk? No doubt. Why? Because if there is a misstatement in the financial statements, that's what the auditor will always be looking at. That's what he will want to look into. Correct? And then we have another risk. That's what you call as detection risk. Now, what is detection risk? Risk that the auditor will not be able to detect such misstatement. Okay. Now, this risk of material misstatement, the first one, which originates from the financial statement. See, this detection risk has nothing to do with the financial statements. It doesn't come from the company, but the first one comes from the company. Now, here again, we can say it has got two components. And what is that? Inherent risk and control risk. Okay, so if you go back, we discussed that audit risk comprises of three things: inherent risk, control risk, and detection risk. Inherent risk and control risk is what you call as risk of material misstatement. And then you have this detection risk. That's a standalone item. Okay. Now what we will try to do is we will try to understand all of these risks one by one. And we will also try to understand, just give me a minute, I'll just get onto that document. Yes, there we are. We will also try to understand as to how do we get into the details of the risk assessment as an auditor. Okay, so this is what we will try to achieve now. Clear? Because potential misstatements which could be there, to identify that is the responsibility, you can say, for the auditor, because that's what the auditor will always be looking to do, because only then he will be able to mitigate his risk. Correct? Now, what we will now do is I'll just share one document in respect of this risk, and over there we will talk about all of these points. So I'll just share one presentation with you, which is in relation to the risk assessment exercise, right? Now, what is the risk? I think if you look at the pictures, these are the risks. So while driving, talking on the phone, driving without the seat belt, isn't it? That's a risk. So how do you define that? Possibility of occurrence of any undesirable event or circumstances. Yes or no? Yeah. So that's how you can always define this. Correct? And we are looking at it from the perspective of the auditor. Now, audit risk is the risk that an auditor expresses inappropriate opinion on the financial statements. For example, issuing unqualified audit report. So if let's suppose there are misstatements which are material. So what do you do as an auditor? If those misstatements remain, you will have to modify the report. What if the report is not modified? You will say opinion is inappropriate. Yes or no? And vice versa could also be there. See, qualification was not required, but the qualified audit opinion is issued. The main point over here is that something which the auditor was required to do, auditor has not done that. And there is only one thing which the auditor is required to do. What is that? Expressing an opinion. Correct? So auditor is required to do this, expressing an opinion. Actually, it all comes down to opinion. And if the opinion for any reason goes wrong, so such risk needs to be evaluated by the auditor. Now, can we say that this flows from the management? To a certain extent, yes. And that is what the auditor needs to consider. Because anything which impacts him will have to be looked at by him. Right? Now, let's understand all of these components one by one in relation to audit risk, inherent risk, control risk, detection risk. Let's understand them one by one. Now, inherent risk. What is inherent risk? It's the risk of material misstatement arising due to error or omission as a result of factors other than failure of controls. Let's suppose there's a set of financial statements. Okay. And there are some misstatements in that set. Now, let's suppose those misstatements have arisen. Why? Because controls have failed. By control, whenever we use this term, please remember it's about the internal controls. In such a case, will you be calling that as inherent risk? No. That's what you call as control risk. Okay. But who has prepared the financial statements? Management. Now, please understand, audit has not yet started. When the management prepared the financial statements, even before you start the audit, there is a possibility that the given set of the financial statements may contain errors. Now, there are only two ways. Now, I'm talking about the stage. Okay, let's suppose this is the date when audit starts. Now we are over here. Audit has not yet started. Financial statements are prepared. Now, what are the reasons as to why the financial statements may contain errors? There are two reasons. Either the controls have failed, and because the controls have failed, so that's why there is some impact flowing into the financial statements. Or some other errors which are not resulting due to failure of controls. Okay. For example, there are certain areas which involve high degree of judgment, estimation. Now, there are chances that such errors, such means other than those arising due to control risk, may arise due to this high degree of judgment, high degree of estimation. Okay. Now, if you have such type of risk, that's what you call as inherent risk. Now the question arises, will this risk be considered by the auditor for planning the audit procedures? Answer is yes. Correct? Yeah. That's an important part. You will have to consider that, right? Saminathan says no. Can you tell me why do you say no? Why would this not be considered? Saminathan, over to you. Do you want to speak? Do you want to speak and explain?
So that is the answer for previous question. I said yes for that.
Okay, sorry. But any further thoughts you'll have on this inherent risk?
No, no, sir, it's clearly explained to.
Okay. Something you would like to add here. So I can understand it's clearly explained. But what is it that you would like to add? Nothing much? Okay, no worries. Now we will talk about control risk. Though we have already discussed about it. Okay. If the controls are not operating in an effective manner, or if let's suppose controls do not exist, definitely there are chances, and in fact in such a situation there will be higher chances of having misstatements in the financial statements. Yes or no? There are high chances, right? Now comes the point. In such a case, what do? Will you be considering that risk as an auditor? Should you be looking into such type of risks as an auditor? Answer is yes. Definitely yes. Why? Because auditor needs to have holistic approach, right? He cannot ignore any such risk, particularly anything which will have a significant financial impact on the financial statements, right? And that's where auditor will also get into the evaluation of internal control system. We'll talk about it as to how that is required to be done. Okay. Now we will talk about another type of risk. So let's suppose now we are talking about a stage when the auditor has actually started the field work. So we are talking about this stage now. Okay. Auditor has started the field work. Field mark means auditor has started the audit procedures, means auditor has started the audit. Now, it's the duty, it's the responsibility of the auditor. What? Any material misstatement needs to be taken care of. But can we say that auditor will always be able to look into every material misstatement which may exist in the financial statements? Do you think it's possible? Tell me, do you think it's possible? Saminathan says no, it's not possible. So there's always a risk. What is that? Auditor may not be able to detect, okay, a material misstatement. So we are not saying that the auditor will always not be able, means he will never be able to detect. No, we are not saying that. But please understand, audit has some inherent limitations. The way the audit is required to be done, the way it's required to be performed, there's always a possibility. What is that? Auditor misses out on detection of material mistake. Right? Now, what could be the reasons for that? Means, how do you think this situation may arise? Let's suppose there's a population. Say this is the population, means it contains a lot of transactions in relation to revenue. Right? Now, auditor has started the audit. Will he be looking into each and every detail? Answer is no. He will be applying a sample on this. Because sampling is what the auditor always applies. Now, when the sampling will be done, can we say that each and every sample which the auditor picks up will capture every type of transaction? Let's suppose this is picked up, this is picked up, this is picked up. Picked up means these are the samples selected, right? Now, does it mean that if errors exist, those will only exist in the samples which have been picked up? Can we say that? Answer is no. Not again, right? We can't say that. Therefore, we need to understand that there is a inherent limitation in the audit. And why do we have the inherent limitation? Because the methodology is such. So we are not saying that the auditor is skipping something intentionally. No, we are not saying that. Okay. But despite being diligent, despite picking up the samples, the way the auditor will want to select, there may remain a possibility of not being able to detect material misstatement. In this case, let's suppose this particular sample had a significant error which has not been tested, and it's not intentional. And as far as sampling was concerned, it was done in a logical manner, right? Now, can we say that this type of risk arises from the financial statements, from the management? Answer is no. Why? Because it's something which relates to the auditor, which belongs to the auditor. Okay. So, detection risk. You will always have after the financial statements are prepared and the audit has started, or even if financial statements are not prepared, audit has started. Okay, clear on this, right? So see, these three terms are very important. Even if you look at it from examination perspective, I would say these three are very important: inherent risk, control risk, detection risk. And as we discussed, these two on a combined basis is called as ROM. What is ROM? Risk of material misstatement. Okay, right? Right? All right. So now, moving further. Risk assessment. Now, in a way, you may find this to be a bit of duplication, but this is important. And I would say the most important part of the planning. Okay, so within this entire planning process, this happens to be the most important part. Risk assessment procedure. If you remember, even in the last session, we touched upon this. If you remember, we talked about significant risks. We talked about not so significant risks or areas. Correct? Now, as the terminology suggests, auditor will be assessing the risk. And the steps will remain same. What are those? Get on to the understanding of the entity. Once that is done, get into the details, get into the legal requirements, get into the I'll get into the understanding of all of these things. Processes, their activities, their flow of transactions, all of these things. Right? And basis the understanding which is obtained, identify and assess risk of material mistake. Applicable financial reporting framework needs to be understood. And depending on the types of risks which could be there. Okay. And depending on the nature of the risk which could be there. What do? You plan the audit. Or basically, you can say you design the audit procedures. Right? Now, when it comes to this risk assessment, it's a part of planning and a process where auditor considers both Risk management by the entity through internal control. Why? Because the management would have already done that or should have done that. And the auditor should get into the details of this. He should get into the checking of this. And all types of audit risk. Why? Because audit risk is something which belongs to the auditor. Correct? Right? Now, in relation to this risk assessment, how should the risk be mitigated as an auditor? So, if let's suppose you were the auditor, how do we go about it? How do we get into that? What is it that we do? Right? So, a lot of things will arise that needs to be looked at. See, at the time of client acceptance itself, you can say stage one. As an auditor, you would have definitely looked into the profiles of the KMPs. In fact, we had this discussion that this is one area which the auditor will be performing, right? Assess the potential engagements, knowledge, experience required, any risks which are associated with the engagement. See, basis the discussions. Basis the inquiries. And of course, looking at, or you can say, documents or evidence. Auditor will eventually get on to these things, right? So that is step number one. Means before you get on to the engagement, before you get on to the client, at least do these exercises. Because if you do that, that's when you get the comfort as an auditor that yes, the audit that I plan to perform will have lesser chances of error, right? So the same thing goes with the continuing engagements as well. See, one is when a new company is coming, for which the auditor needs to decide whether to do that or not, for which auditor will get into the background check of KMPs and of course obtain the details of the companies whether to accept or not. In a similar manner, though we have talked about it in the previous sessions as well, in the similar manner, auditor needs to do the similar sort of assessment for the continuing clients also, right? Next, for an auditor, the basic premise happens to be independence. Yes or no? See, this is the most important requirement. You can say the base, without which it's not possible to do the audit, right? It's the basic premise over which the audit will flow. So, as an auditor, what do we need? Let's look into these activities. Engagement partner or the leader to circulate independence conflict check. See, as a firm, I'm not talking about the engagement team right now. Independence is required to be looked at, right? So before you start the audit, In fact, before you accept or continue, independence is required to be looked at. So how do you do that? By performing this procedure. Okay. Consider the applicable independence requirements, whichever are applicable. Engagement team members should sign independence declaration immediately. See, this is more about a process. In fact, if you go to SQC that we discussed, therein again we picked up a similar sort of point, right? Auditor also needs to evaluate non-audit services. See, all of these aspects are related to independence only, correct? Next, engagement letter. Now, is that important for the auditor? Answer is yes. In fact, ideally, audit should not start till the time arrangement is not there between the company and the auditor. See, actually, this thing applies to each and every type of contract. It's not limited to only audit. Yes or no? This doesn't only apply to audit, it applies to all. But because we are talking about audit here, so that's why for the audit, what do we need to ensure? We need to ensure that the terms are clearly understood. Scoping, responsibilities are all clearly agreed as to what is there on the part of the management, what is there on the part of the auditor. That's required to be put in place. And then comes the part related to planning, which is actually stage 2 that we have discussed so far. Okay, because when you plan, right? When you plan, you look into all the things. You will look at the team which is required, experience of the team, number of the team personnel, their roles and responsibilities, providing a download of any available information to the team members. Similarly, as far as the company is concerned, or the client is concerned, or the engagement is concerned, obtaining the understanding, processes, what could go wrong, all of these things become important, right? When it comes to the reporting, there again, there has to be some mechanism on the part of the auditor. What is that? See, quality is important. Yes or no? So the auditor needs to decide, assess, which will actually be forming part of the SQC1 for the auditor as to how do you set up, right? Means what is going to be the outcome and what is the process for getting the outcome. See, one is the final outcome that you receive. The other part is the entire process that you follow for getting that outcome. That is where the work is required to be done the most. Because outcome is something which is not in your control. So what do you do about it? Do you do anything about it? Can you actually do about anything on that aspect? Answer is no. You can't do that. Yes or no? Now, continuing on the same point. Now, in relation to this risk assessment and internal control, What we have done is we have just tried to look into the audit risk as a process, and of course the risk assessment as to what all is required to be included there. Correct. Now, this will help the auditor getting onto the designing of the audit procedures. Now we move on to the next part, which is related to internal control. So let's suppose risk is discussed, understood, taken care of. But there comes the point, how is that taken care of by the management? And that's where internal control system comes into the picture. Yes or no? Now, what is internal control system? It means just highlight this. Internal control system means all the policies and procedures adopted by the management. Now, this part is important. Adopted by the management of an entity to assist in achieving management's objective of ensuring orderly and efficient conduct of its business, including adherence to management policies, safeguarding of assets, prevention and detection of fraud and error, accuracy and completeness of accounting records, and timely preparation of reliable financial information. See, this is something which the management must be looking at. They must be trying to achieve this, right? Now, for this internal control system, what are the objectives? Transactions are executed through general or specific management authorization. All transactions are promptly recorded in an appropriate manner. Means we are talking about the systems, okay? Assets and records are safeguarded from unauthorized access. So this is also a part of, you can say, internal control system. Assets are verified at reasonable intervals and appropriate action is taken. See, sometimes what may happen is such type of questions you may see in the exam. Of course, you will get a scenario, but the scenario may be looking at these objectives only, right? So you can just simply understand there are only 4 points. If you understand these points, of course, some of the key terms which are relevant, then these are the questions which you are eventually going to face also. Okay. Next. Now, if we talk about internal control, does it have some limitations? Answer is yes. I think it will be good to go through those. Management consideration that the cost of internal control does not exceed the benefits. Now, see, this is a very common problem in case of small companies. Why? Because every time you set up any system, there will be a cost to it. Yes or no? There will always be a cost to it. So that's why it's important on the part of the management to do this exercise. You can say cost benefit analysis. Okay. And when it comes to a small company, they will always have limited amounts. So for them to get into the details of this, is important. Next, the fact that most internal controls do not tend to be directed at transactions of unusual nature. Potential for human error, such as due to carelessness, distraction, mistakes of judgment, all of these things could have been there. Possibility of circumvention of internal controls through collusion, no doubt. And basically, we are talking about a fraud risk here. Yeah, if the management is not involved, employees are doing this. So the management needs to have a strong system basis which they will be able to track it. Possibility that a person responsible for exercising internal control could abuse. So we are talking about management override. So this is a situation called as management, means the management is overriding its own controls. Yeah. So if the management is doing that, there again we need to find out whether there is any fraudulent motive behind that. Okay. Now, in relation to the structure, see, structure, I would say, internal control is all about ensuring that the risks or the what could go wrong are taken care of. In a very simple manner, if you have to understand internal control or the system, it's about that. But for you to get into the details of this, some of these points again become important. See, in order to achieve objectives of internal control, it's necessary to establish adequate control policies and procedures. Now, what do they cover? So, if let's suppose you have those policies, procedures, what do they cover? Number one, segregation of duties. Very important, very common, and very effective procedure. See, if you divide the work and if you allocate that in an appropriate manner, so what have you done? The person who is doing the work that becomes responsible, right? So the responsibility gets shared. Number one. Number two, this maker checker concept comes into the picture. Means somebody who is doing the work, other person is reviewing that. Correct? Authorization of transaction. Now, when we say authorization of transaction, so actually over here, we are talking about authority metrics. Yes or no? Yeah. We are in a way talking about the authority metrics. Correct? Now that again is important. Why? Because as we discussed that maker checker, that's an important part. Right? Adequacy of records and documents. Now again, this is important. Because if the records are lost, if the records documents are not preserved in an effective manner, then this can again have problems or result into problems. If let's suppose tomorrow any regulatory review is picked up, what do you do? How do you get onto that? What do you achieve? Yes or no? So that's why it's important in relation to the records and documents. Accountability and safeguarding. I think we have already talked about it. Checks also, we have talked about it. See, if you look at the internal control system, it includes 5 components, and I think this is again a very important part, particularly from examination perspective also. Control environment, number one. Risk manage assessment process. control activities, information system and communication, monitoring of controls. All in all, these are the 5 components. Correct? Now, let's talk about control environment to begin with. See, basically, we are talking about the environment. Okay. Now, for this control environment, what all things do we need to include? Communication and enforcement of integrity and ethical values. Very important, right? Commitment to competence, again, very important because till the time it's not there, you don't move towards quality. Participation by those charged with governance. So if you remember, while discussing a communication by auditor to the TCWG. Okay. Therein we discussed that the role of TCWG in respect of various aspects of audit is very important. Can you help me understand how does it help the audit? Yes. Saminathan, would you like to share some thoughts on this? How do you achieve that? Yes.
Sorry, yeah, it should be a two-way communication between the TGW and the audit engagement team. Whenever there is a query or question, first you need to check with them. They will assign to the appropriate person to collect the sufficient and appropriate audit evidence.
Okay, very good. Now, in this case, now comes the point. If the TCWG is working in an effective manner, so what is the role of TCWG? It's actually not only their role, it's also their duty. And in a way, auditor is working for whom? TCWG. Yes or no? Yes or no? So that's why participation by TCWG plays a very important role. Why? Because basically we are talking about a situation wherein something flows from the top that will have the most significant impact, right? Next, again, it becomes important to understand what is the philosophy, operating style of the management, what is the structure. If you talk about authority and responsibility, how is that getting assigned? Okay, including the policies, procedures, practices for people, right? Now, in relation to the control activities, so let's talk about the control activities. Control activities that may be relevant to an audit may be categorized as policies and procedures pertaining to the following. Now, what is that? Performance reviews. Okay, so these control activities include reviews and analysis of actual performance versus budget versus forecast, prior period financial information. Yes or no? Information processing. So basically, idea is to discuss about the technology here, right? See, with the fast changing economic environment, technology plays a key role. And because the auditor has to go and verify systems, processes of the company, what do they need? They need clarity around this. They need understanding about this. Because if you look at some of the organizations, they are completely computerized. Things are working in more or less in an automated manner. So I'm not saying whether it's right or wrong. I'm saying that's how the things are working. So therein the understanding of IT becomes extremely important. Why? Because that's when you understand again the same thing. Stu, what can go wrong? Okay, similarly, you may have physical control, segregation of duties. I think we have already talked about it, right? Now, monitoring of control. See, this monitoring of control again is very important. To set up a control system helps. But this overall system of internal control that we talked about has to be implemented, has to be operating in an effective manner. Okay, now if we look at internal control, it comprises of administrative control and accounting control, internal check system, internal audit. So these are some of the terms that we get to here. Yeah, so let's understand what is this internal check system. See, internal check system basically we can say is a system of bookkeeping and arrangement of staff duties in such a way that no other person can carry through a transaction and record every aspect thereof. Okay, so you can say management has identified a team which will keep doing a checking on a regular basis or maybe after some intervals. What is the objective? Again, any potential misstatement. That's the objective, right? Now, in relation to internal audit, let's understand what is internal audit. So we can say internal audit is actually an independent appraisal function established within an organization to examine and evaluate its activities, right? And internal audit as a term is very common. We have also talked about this internal audit earlier. See, internal audit, you can say, actually helps the management understand, first of all, and also fix up any gaps which are there in the system. So, definitely, financial statement happens to be a part of the system. So, anything around that will help the statutory auditor. But as far as internal auditor is concerned, some of the things which may not have the financial impact may become important to him. Yeah, so that's why both the aspects are required to be considered, but it will always be dependent on one thing. Okay. And what is that? How strong is the system? Right? Then, of course, this review of internal control system is required to be put in place. Okay. Now, this assessment evaluation, I think we have already talked about it. Next comes another important area, and this is what you call as techniques of evaluation of internal controls. First technique happens to be questionnaire. Now, what is a questionnaire? It usually consists of several separate sections devoted to different processes of an organization. Questionnaire is intended to be filled by the company executives who are now in charge of various areas. Okay. Now, what is it that the auditor is trying to achieve by having this questionnaire? See, the questionnaire is providing you a list of all the questions. So you can say, in a way, it provides a guidance. Yeah. So some basis of system is available to the auditor. Checklist, I think we have already, sorry, checklist is the other one. It's a series of questions or instructions on internal control, which the auditor must follow or answer. Now, in case of a checklist, a question arises that how is it different from questionnaire? See, it's in the form of a question which is generally required to be answered yes, no, or not applicable. And of course, any reasons are required to be put down. Okay. Next, flowchart. See, the flowchart is sometimes used by the auditor, sometimes not used, but leveraged upon by the auditor. So this technique actually provides the entire process in a diagram, or you can say diagrammatic manner. Yeah, but this also gives you complete clarity. At times, if there is a flowchart which is available, that helps you obtain an understanding in a better manner as compared to just going through a complete descriptive of that and basis which you try to get into the insights. Okay, right? Clear? So if you look at some of these points, these diagrams, these are basically around that part only. Correct? Now, I think reporting and all is definitely a consider, but we will talk about it. Frameworks of internal control. It's talking about as to the framework or the basis which has been used for putting it into place. Similarly, if you look at the international frameworks, so you have this very commonly framework called as COSO, integrated framework issued by the committee of the sponsoring organizations of the tradeway or commission, right? Now, sometimes you may be asked about some of these aspects. You can always discuss that basis the discussion we have had so far, right? Okay, so now see these are all of those frameworks. So that's why I'll want to not really get into too much details around it. Now, as a next step, what we will do is we will get on to the materiality. Okay, but I believe that before the discussion on the materiality, we can take a break, right? Okay, so I think we can take a break and then we'll continue with our discussion with materiality. Okay, yeah. So Ashok, we can take a break now. We'll talk about materiality briefly. Yeah. Okay, so over this materiality, we have had this brief discussion earlier. But now what we will try to do is we'll just try to get into some more details around the materiality. Okay. So I would just share one document with you. The materiality as a concept we have talked about. Now, in the context of audit, materiality basically reflects any item which goes into the financial statements, which is of, you can say, significant value generally. That's how the materiality is looked at in most of the cases. Means you can say basically we are talking about a quantitative threshold in such a case. Yes or no? So that's one way to look at it. The other way could be not to get into the quantitative threshold. Say, for example, in such a case, what do? You go by the qualitative considerations. Now, what could be the qualitative consideration? Any transaction, any disclosure which is considered to be of significant importance, even though this amount may not be very big. So that's what you will call as a qualitative assessment, right? Now, important part is to understand what is the need for that. See, here again, the need is very simple: planning. Here again, what are we talking about? We are talking about planning process. And for this planning, materiality plays a very important role. Why? Because for an auditor, material misstatements are required to be looked at. Means that's what he will always be focusing upon: material misstatement. Yes or no? So that's why any material misstatement, if it's there in the financial statements, that's a problem factor for the auditor. He needs to look into it, right? So that's why it's evaluation. Why? Because something will have to be considered by the auditor. Means what is the benchmark, what is the amount, or what is the basis he picks up to decide what is going to be the misstatement which is crossing that threshold. So where will he do that? Planning stage. Yeah. Now, once the materiality, let's suppose, is determined at the planning stage, its application will be done. Yes or no? So we have determined the materiality. And why do we do that? Because we apply that at various stages, right? So you can say its application will arise. But another point to be noted around the materiality is that even though we have determined this at the planning stage and it's going to be applied at the subsequent stages, it may have to be relooked at during the subsequent stages. Why? Because actually it's a kind of planning. And for the planning, we have discussed that any changes, if required, may have to be made even during the execution stage. Okay. So therefore, we can't say that because the materiality is once determined, it's closed, frozen forever. No, that may not be the right thing to be considered. Okay. Now, for this materiality, there are various roles. Now, what are those roles? Most important, the primary thing is the threshold, basis which conclusions will be done, basis which reporting will be done. Why? Because if there is anything below materiality, and that's an error. So, will that be a problem factor for the auditor? Yes. But it will not be such which will have to be reported upon. Means reporting implications will not arise for such an item. Yeah. As regards the extent of testing during the execution stage, materiality plays a role. Why? Because again, depending on the materiality, sample selection is done, the number of samples, and the types of samples as well. Because many a times, maybe a benchmark is used that let's pick up the transactions which are say greater than 10 lakhs. Okay. Or let's pick up 100% transactions which are greater than 25 lakhs for verification. So you can say there are different ways through which this materiality as a concept is applied, not only at the planning stage, but at various stages of the audit. Okay. Now, without the materiality, what will the auditor do? Will he be able to plan the audit procedures? Answer is no. Will he be able to decide as to the extent of the testing? There could be under audit, there could be over audit. Both the types of situations could be there. Yeah. So that's why this redetermination of materiality is considered to be a very critical thing. Okay. Now comes the point that how do you determine materiality? Means what do you do? How do you go about it? What will become the basis? Now, for this materiality to be determined, there are some benchmarks, okay, which are provided. Now, what could be the benchmark? You can say PBT could be the benchmark. The revenue could be the benchmark. Similarly, total assets could be the benchmark. So, of course, you look at the underlying data therein, but some of these things can become the benchmark. For example, a company having good profits on a consistent basis may choose, say, for example, a certain percentage of PBT. Generally, a range of 5 to 10 is considered when it comes to the PBT as a benchmark. Okay. But here again, can we just go and randomly pick up any benchmark? Answer is no. So that's why what do you do? All of these benchmarks which are available, which we plan to use, we need to decide, we need to assess. Okay. We need to assess as to which of these benchmark will be the most appropriate one in the context of the audit. So we just can't go and use any benchmark over here. Now that is another consideration. Yeah. So this also plays an important role. So that is where the professional judgment is required to be considered. And for doing this, there are various factors. Size of the entity, type of the entity, complexity of the transactions. There are various factors which are required to be considered. So that's why if somebody says that let's pick up materiality as 5% of the PBT for each and every type of entity, will that be appropriate? Answer is no. Say a company is making profits, other company is into losses, and the other company is not consistent in terms of profits. Okay. So therein, to say that we set up a benchmark or we fix a benchmark will not be appropriate. That may give a wrong picture, right? So that's where all of these factors become important for determination of materiality. And that's why it's not an easy exercise, requires judgment. Of course, past history, basis considered in the past years, a lot of such factors are also required to be considered. Yeah. Now, materiality is calculated by selecting a suitable benchmark and applying a reasonable measurement percentage. Okay. Now, let's try to look at the possible benchmark which could fit into these scenarios. So as we discussed, there are various factors. So now comes the question, what could be those factors or what could be the types of the entities? So let's suppose if you say type of the entity is one of the factors. Okay. So in such a case, what do you do depending on this type? Okay. Or depending on the nature of the business of the entity. So what do you apply? What do you consider in some of these situations? Right? So I would advise some of those who are not around who will just looking at it later on, just think about it. Okay. Yeah. Before just immediately getting on to the solution, just think about it as to what you think has to be the right answer. And that's when you get on to the solution of this. Now, those who are around, I would request you to answer this. For the commercial, means for profit entities, what should be the benchmark? Tell me, Saminathan, what will be the appropriate benchmark? Tell me. Okay, great. Saminathan says it has to be profit. Very good. So can you tell me why should the profit be considered as the benchmark? So one is you are saying this is the benchmark. But what is the rationale? Why should that benchmark be considered? Tell me. Yes. So what is the reason? So Swaminathan says because the entity is generating profits year on year, means they are having consistent profits. So that's why if you pick up PBT and you apply that, there's nothing wrong about it, right? Next, if you look at public or listed entities, what do you think will be the appropriate benchmark? Of course, there are various other factors. So you should not be thinking that for every public company or every listed entity, this will become the criteria. But what do you think? Over to you quickly. Very good. So now Swaminathan says revenue can be considered, PBT again, and assets again, depending on the factors, right? So now in this case, I'm assuming that for such entities, again, the profits are consistent. So that's why PBT could again be the benchmark, right? Next, third, entities with volatile profits. What do you think will be the appropriate benchmark? Over to you. What do you think will be the appropriate benchmark for the entities which are having volatile profits? Over to you. Great. Swaminathan says asset could be the one, right? But before we get on to the assets, we need to look at this revenue. See, the profits are volatile, no doubt. So can we just go look at these PBT? No, because the consistency is missing. But what if the revenue is consistent? That will be the right benchmark. Of course, depending upon other factors as well. Next, entities at break-even level. Now, in this case, what do? Entities at break-even level. What is the appropriate benchmark? Entities at break-even level. In this case, what do? Which one you will consider? I would say here again, very rightly, Swaminathan mentioned revenue could be the one. Yes or no? See, the profits are not there. So that's why revenue. But of course, total assets can be the consideration. But that again will be dependent on where is the fact. Entities reporting losses, again the same thing. Very small and closely held entities. Now you may be wondering that if the entity is small or closely held, for example, private limited company, why would there be any factor for that? So just think about it and let me know which benchmark you would like to consider for such type of entities. Tell me which benchmark you'd like to consider. Okay, Swaminathan says assets. Very good. So there again, see, because these entities are such that their profits are generally not considered to be stable. Okay, not for profit. Say, if you come across an entity which is non-profit, okay, so it's not for profit. So what do? What do you consider? So you do not have profit or loss anyways. So what do you consider? There again, it will have total income. So no, right? And of course, total assets can be the benchmark. Next, if you talk about financial institutions, NBFCs, what do you consider? Which benchmark you think could be the appropriate benchmark for such type of entities? Just think about it quickly. I think Swaminathan is sharing the answer. For financial institutions, NBFCs, etc., what could be the appropriate benchmark? So let's look at this, right? Total advances. Total assets, of course, could be the consideration. But see, advances are something which form a considerable portion of the balance sheet, generally for such type of organizations. So in their cases, you can say it's a very important criteria for the business, right? So there again, Swaminathan has similar sort of answer. Very good. Okay. Yeah. So idea was to just get into an understanding of what all benchmarkings could be there. And when it comes to the benchmark, If let's suppose benchmark is established, after that, where do we go? After that, we go to the range. See, benchmark will give you the basis, but using that benchmark, you need to determine the amount. So let's suppose if you pick up PBT, so there comes the question that what is the percentage you'll apply? So do you have any fixed percentage? No. So there's always a range, right? Similarly for revenue, total assets. Now please understand that even though we are talking about some of these ranges, okay? Now in respect of those ranges, there again different criteria will have to be considered. Now what are those criteria? Let's suppose a company has a history of making misstatements. Now, there are definitely chances of errors in the current year as well because there's a history. So that's the thing, that's the thought, or you can say that's the consideration you would have had during the planning stage, and that's why you would want to keep your materiality at a lower level so that any such errors are taken care of. Because if you increase the size, you'll not be able to catch that, right? Similarly, that's why I'm saying there are various factors for you to look into, right? Okay, so now let's look at this case scenario. Okay, now ABC Limited is a company providing IT services across different sectors. It's specializing in providing solutions through AI. Major clients of the company is from BFI sector, banks and financial institutions, and this is a listed company. Its profits are 500 million, revenue is 6500 million, total assets are 1600 million. Year on year profits of the company are growing at an average of 8 to 10%. So that's the profit growth. But in the current year, an impairment loss is recorded amounting to INR 200 million, which is adjusted in above profits. Okay. Company over the past years has maintained a good dividend payout ratio, and the investors drive their return on investment from this. Now, in this case, first question, what is the most appropriate benchmark you would like to consider here and why? Yes, your thoughts? Saminathan, you would like to share this? What is the most appropriate benchmark you would like to consider and why? Okay. He says B and why? He says, I would like to consider the profits after making the adjustment for impairment loss. But why will you do that? Why would you do that? Reason for the same? So in a way, we are trying to normalize that. Yeah, because it's unusual. So that's why, as we say that profit should be consistent. So basically, you are trying to remove the impact of any unusual items to get into the better basis. Yes or no? Right? Then of course it's talking about the materiality. Would your materiality change if the company is a closely held private company? Over to you. Tell me, what do you think? Do you think that the moment the structure of the entity changes, that will have some impact on your assessment? Answer is yes. We just discussed about it. Okay. I'm not saying that this will necessarily change, but this consideration has to be done. Okay, clear? Now, see, within this materiality, there's another concept that is called as performance materiality and a concept called as trivial. Let's suppose materiality has been calculated as, say, any amount. Okay, let's suppose any amount has been calculated in terms of materiality. 100. Now, what is our objective? All the errors up to 100, auditor can live with that. Yes or no? Yes or no? Now, see, audit has inherent limitation. What is that? It may happen, we just discussed, due to detection risk, auditor may not be able to capture some of the errors. Remember the detection risk? Yeah. Hopefully you will now be able to relate to all of those terms. But we also discussed that if that is a risk, so that's how the things are. So what is it that the auditor needs to do? Actually, it's not an intentional thing on the part of the auditor. So is it a deliberate miss? Answer is no. But the auditor needs to do something about it. Correct? Yeah. Now, what is going to be that something which the auditor needs to do? And how will that be taken care of? So what the auditor can do is, auditor out of this 100 can keep a cushion of 10 for such type of detection risk and reduce this materiality to a level of 90 so that all the errors up to 90 he will ignore, and thereby he is also considering another 10 so that if there are some errors which he couldn't detect, those would have been covered within this range. Now you may be thinking, why is this 10? So this could be 10, 20, 30. Now this percentage again has to be decided by the auditor. It's judgmental. But this 90 is what you call as performance materiality. So performance materiality is a lower threshold, okay, wherein the auditor has given himself some cushion, right? Auditor has given himself some cushion, correct? Third, trivial. See, trivial is a very minuscule amount. During the course of audit, lots of errors may arise, small errors. Now the question arises that if there is any amount which the auditor can decide, below which, if there are some errors or accumulation of those errors, and if he can ignore that completely, okay, that is achieved with the help of this trivial, or you can say a threshold which is called as trivial. It is again called by a different name as well, CTT, clearly trivial threshold, and a different name called as de minimis. Okay, so these are the similar, you can say, meaning in terms of these terms being used, right? Clear on this? Now, how does it help? See, all of these things will help the auditor in assessment and in terms of performing the procedures in relation to different sort of things. Now, For these type of situations, we'll try to understand as to how this is going to impact. Increased risk of misstatements arising from introduction of significant new accounting system potentially affect multiple classes of transactions, account balance, and disclosures. So will you decrease? Answer is yes. Why? Because you want to give yourself more room. That's why you will decrease the materiality. Next, numerous misstatements were identified in prior audits, and there is also an increased risk. Sorry, there's also an identified risk of material misstatement due to fraud. In this case, what do you do? Do you increase or do you decrease? Over to you, Saminathan. Anyone else? In this case, what do you do? Decrease. Once again, very good. Saminathan also mentioned. Next, few misstatements were identified in prior audits. Internal control system is strong, operations are stable, and it's a low risk. So definitely you would want to increase. See, if you decrease the materiality, actually you are increasing the extent of testing. And if you are increasing the materiality, so you are decreasing the extent of testing. Okay. Yes or no? Yeah. Next, misstatements identified in prior audits, generally arising because the entity is a small one and the accounting staff is under-resourced, which prevents entity from designing and implementing effective. I think there again, we have a simple answer, straightforward. In this case, what do you do? Increase or decrease? Great. Saminathan says decrease. I think very relevant, right? Reassessment, we have discussed that, of course, you can't be rigid in respect of the materiality which has been looked at. Now, looking at this situation, okay, just give me a minute. Okay, so let's look at this. In what situation should an engagement team consider whether revisions to materiality are appropriate? A. Entity has a substantial sale in the fourth quarter that was not initially anticipated in the planning of the financial information that was used to determine materiality initially. B. After determining materiality on the engagement, team discovers an immaterial error due to reconciliation difference. C. Entity disposes of key parts, a key part of its business after materiality has been determined. D. After determining materiality on the engagement, team discovers material fraud in revenue. In this case, which all situations or which one you will consider? Saminathan says it's D. So let's look at this, right? So in this case, what do you do? A and C is what you consider. Correct? And D. Now, documentation, I think we are familiar with this, that documentation is something which plays a key role, isn't it? So every time anything that you do, if you don't document that, so what is the messaging? Messaging is very simple. If that is not documented, that is considered as if it's not done. Right? Yeah. So that is considered as if it's not done. Okay. Now, Now what we can do is, now we can just move on to the questions. Just give me a minute. Pick up some more questions. Okay, so let's look at this one. CAR is conducting statutory audit of a divisional office of a public sector insurance company. See, every time, whenever you look at the company, please also try to get into the structure. Okay, that actually helps. It will have some impact in some of the cases in relation to the audit. So that's why some of these things you may not just simply ignore, right? So that's the thought process. Now, it's a statutory audit of a divisional office, and this company is into insurance. Okay, and it's a public sector company. On going through delegation of powers laid down by company's head office, it's noticed that surveyors in claims under property insurance policies beyond estimated amount of 30 lakhs are to be appointed by divisional claims committee. However, on going through surveyor appointment details of 10 such claims during the year, 5 instances have come to his notice where above delegation of powers has not been followed and appointments were made by divisional manager in place of DCC, means Divisional Claims Committee. In the beginning, auditor had assessed risk of material misstatement to be low. Describe why the above finding would change auditor's assessment in relation to the above. Now, before you answer this, there are few points you need to understand. See, in the given question, one part is already answered for you. So the question is not asking you whether the auditor's assessment would change or not. It's given in the question. So they are saying auditor's assessment would change. This actually helps you to move into a single direction. Yes or no? You are only required to get into the rationale, just the thought process as to why should have that been considered. Right? So now in this case, Swaminathan, you would like to answer this?
Yes, sir. The audit risk, as we studied, is a risk of material misstatement into the reduction risk. In this case, they specifically the control they placed, but however, the divisional claim committee is not. However, ongoing process survey appointment 10 details such claim during the period instance come notice where above delegation power has not been followed, which means the control is the policy is there, the decision is there, but which is not implemented effectively. During the audit, definitely auditor has to reassess the control risk accordingly. The materiality has to be fixed again.
Okay, very good. Now, in this case, when it comes to the reassessment, you can say in a way we are talking about Getting back to the stage one, and what is that? To perform some sort of planning. Yes or no? So if you are doing the reassessment, what does it mean? Means you are doing the, or you are replanning some part of the things, or maybe the entire setup you may have to replan. Statutory audit of this divisional office noticed that the procedure related to delegation of powers has not been followed. Now, when it comes to delegation of powers, for any organization, as far as its control system is concerned, okay, in relation to the control system of an organization, delegation of powers is considered to be an extremely important area. So if that goes missing, so it reflects on the control environment. Yeah. And it can have a huge impact. Why? Because if there are some breaches, so you don't know, there could always be a management override, which could be a significant issue, right? In the given scenario, this is a insurance company and that too public limited. For such type of companies, any such activity is considered as a serious offense undoubtedly, right? For the control environment, we have already discussed. It's a failure. Such deviations from established controls may lead to auditor to conclude that the control risk needs to be revised. Undoubtedly. Yes or no? Revision of control risk assessment is likely to lead to revision in risk of material misstatement. It may also result in modification of nature, timing, as well as extent of planned substantive procedures. Okay. Next. Now, next one. RK Living Limited is engaged in manufacturing and processing of textile fabrics. It purchases its raw material from a company based in Silvassa, which is taxable at the rate 12%. It takes about 3 to 4 days for raw materials to reach the company's plant. Recently, the company has revamped its internal control system for recording its transactions. Okay, so there's a revamping. You have also assumed charge as head of internal audit department of the company a few days before. Means you happen to be the internal auditor and you are heading that. Okay. It is noticed that information system requires booking of purchases in purchase ledger and stock records from the date of purchase invoice only. How would you deal with the above matter as internal auditor? See, the point is very simple. Do you find any concern? So let's try to keep it in a very simple manner. Do you find this to be any concern? If that is the concern, that's what you need to get into. Yes. Swaminathan, once again, would you like to share some thoughts on this?
Yes, sir. There is a information system is not appropriately designed and implemented. The reason is that the purchases once received, that time only they are putting the stock. Stock can be received later or prior to the invoice is received. Actually, the shipment maybe get delayed sometime in transit. As soon as they received the purchase invoice, if they are booking in the system, then it is a material is not received but booked. But sometimes the material will receive prior to the invoice. That also is possible. That the system is not properly implemented in this case, I believe.
Very good. So there again, we are sort of looking at similar type of situation, and that is about the systems. See, for an organization, its system is the most important thing. If the systems are in place, definitely there are going to be lesser mistakes. But if the system is not in place, chances increase significantly for the mistakes. Yes or no? Yeah. And you have similar sort of situations over here also. So that's why, what do you need? You need to get that fixed. Now, as an internal auditor, what is your role and responsibility? Your role and responsibility includes not only to identify the problem, but to also get that fixed. So, how do you do that? Yes or no? Yeah. So, the internal audit involves continuous and critical appraisal of the functioning of an entity with a view to, now this is an important part, with a view to suggest improvements there too. Now this is an important part, suggesting improvements, add value to, strengthen the overall governance mechanism. Okay. Internal audit also involves evaluation of internal control to provide assurance to the management regarding design, implementation, operating effectiveness of control. In the given situation, information system requires booking of purchases in the purchase ledger, stock records from the date of invoice. Is that appropriate? Clearly no. How can you record the stock from the date of invoice? Because the stock is received, let's suppose today, invoice is received 1 week later. So that's not the appropriate basis, right? Such a control system is likely to present a distorted picture of the stocks of the company. It would show stock of raw materials as received, whereas these goods could be in transit. Because many a times what may happen? Goods are not physically received, but you have an invoice in place. Yes or no? Therefore, the design of the control itself is faulty, which allows booking from the date of purchase invoice only. Further, such a system can have implications with respect to GST laws. Right? Internal auditor should report on the above matter, asking management for corrective action. Okay? Yeah, clear? Next. Company, as part of its internal control setup. So here again, we are talking about the internal control system. So what is the system? A system under which quarterly budgeted targets in respect of sales are analyzed with respect to actual performance achieved. It also involves fixing responsibilities of different product departmental heads and taking timely correction. In case of product departmental heads not achieving quarterly budgeted targets, they have to give a detailed justification for the same and also lay down how shortfalls would be compensated in ensuing quarters. Identify and explain component of internal control alluded to in the given scenario. Okay, yeah. So any thoughts again?
Sir, it's relating to control activities actually. In the
Okay,
control activities wherein we can review and analyze the actual performance against the target and what went wrong, what happens. All this analysis will be done in the control activities.
okay. Basically, if you look at the component of internal control which we are discussing is the control activities. Okay. Such control activities include reviews, analysis of actual performance versus budgets, forecasts, prior period performance, relating different sets of data, operational or financial, to one another, together with analysis of relationship and investigative and corrective actions, comparing internal data with external sources of information, review of functional or activity performance, control activities pertaining to analysis of budgeted target of sales with respect to actual performance, fixing of responsibilities, taking timely corrective action falls in the nature of performance reviews. And such performance reviews are part of control activities. And that is nothing but a component of internal control. Next, CAS, statutory auditor of a listed company, on reviewing the internal controls of the company, is of the view that there can be possible situations, okay, possible situations where the insurance premiums for keeping insurance policies current in respect of various assets of the company may have become due and payable, but internal control systems established by the company may not be able to capture it. In this case, if let's suppose you happen to be the statutory auditor, how would you deal with this? As the auditor, what is going to be your approach in the given scenario? Okay, so once again, Saminathan, any thoughts on this?
See, in this case, there is a clear evidence that there is internal control deficiency is there. The management has to define the internal control policy in such a way that it has to detect the existing issues in it. They failed on these cases. But however, the auditor can recommend to the management or those charged with governance, stating that what are the policies and how the check to be done, and what are the items to be checked, and how to check when to be checked. And they also recommend the list of items, the policies, existing policy number, when it's expired, when the due, what is the premium mode. That kind of checklist the company should maintain actually. Accordingly, they should renew it as and there when there is due.
Yes, good. So in this case, deficiency in internal control exists. But when does it exist? So if you look at the guidance, a control is designed, implemented, or operated in such a way that it is unable to prevent or detect and correct misstatements on a timely basis. So that's one way. Or control necessary to prevent, detect, conduct misstatements in the financial statements on a timely basis is missing altogether. Yes or no? That is missing altogether. In the given situation, so if you look at the given situation, what do you find? In the given situation, There's a possibility that internal control systems may not be able to capture insurance premiums which have become due and payable. If you look at the nature of the business and the kind of control failure that we are looking at, it's a serious problem for the company. That's why you will call it as a significant deficiency. As failure to keep insurance policies current would render the assets of the company uninsured. It may lead to losses for the company in case of any eventuality. Further, if you look at the requirements of SA 265, significance of a deficiency or a combination of deficiencies in the internal control depends not only on whether a misstatement has actually occurred, but also on the likelihood that a misstatement could occur and the potential magnitude of the misstatement. Significant deficiencies may therefore exist even though auditor has not identified misstatements during the audit. Susceptibility to loss of an asset is a factor in determining whether a deficiency constitutes significant deficiency in internal control. Okay. The auditor shall communicate in writing significant deficiency in internal control to TCWG and include in the written communication of significant deficiencies in internal control. So what will he communicate? What will he write down? Discrepancy, which is there, means the deficiency, and describe that, its potential impact. Sufficient information to enable TCWG to understand the context. It's the proper evaluation which you would have done. He would put down some of the facts around it, okay, for better clarity. Next, CAB was appointed as the auditor of ABC Limited for the financial year 23-24. During the course of planning, means when the audit planning was going on, B intends to apply concept of materiality for the financial statements as a whole. Please guide him with respect to factors that may affect identification of an appropriate benchmark for this purpose. Okay, so first you need to give the guidance. Okay, so first question is quite generic. Then it says, so there are various parts to it, this question. So I would say this is A, then B. What benchmark should this auditor adopt if ABC Limited is engaged in manufacturing and sale of ACs and is having regular profits? So you can say B1, B2. If let's suppose the company is engaged in construction of large infrastructure projects and incurred losses in the previous 2 financial years due to pandemic. So actually there are 2 parts to this question. Yes or no? Yeah. Saminathan, would you like to attempt all these parts one by one?
Yes, sir. Benchmark, as we discussed, the on the total asset, revenue, and total expenditure, and the equity. These are
Okay.
the benchmark can be fixed for
Right.
that. When the entity is a life cycle entity, then industry economic which the entity is operates usually.
Right.
With respect to that manufacturing and sell of air conditioner and having the regular profit, when it is having the regular profit, definitely the PAT, profit before tax, the revenues can be the total revenue can be considered as a benchmark on that case.
Okay.
And the other item, the large infrastructure project and the incurred losses.
Hmm.
In this case, when there is a losses, that revenue cannot be sorry, the profit cannot be considered as a benchmark. In that case, they can consider revenue
Hmm.
as a benchmarking.
Okay. And why do you think it should be the case?
Which one, sir?
This second one for the infrastructure one. So, what is the
It's in
rationale for you to consider that?
it, because it's incurred loss in the previous 2 financial years.
Okay.
Okay. So, okay, in this case, when they consistently, when they are incurring the losses also, in that case also they can consider that profit as well as a benchmark because the
Right.
consistency is there.
Okay.
Okay, either it can be do it with the revenue or the profit, which means a loss.
Okay.
They can consider
Right.
as a benchmark. Yeah.
Okay.
See, I didn't look at that two consecutive year in this case.
No, no, that's okay. Very good. Now, let's look at this. Okay. So, as we discussed, first part is generic, wherein you are required to give the guidance. Now, what is the guidance that we have? There are some factors you will consider. First, elements of the financial statements: assets, liabilities, equity, revenue, expenses. Whether there are items on which attention of the users of particular entities' financial statements tend to be focused. Okay. Now, what could those items be? Say, for the purpose of evaluating financial performance, users may tend to focus on profit, revenue, net assets, nature of the entity, where the entity is at where in its life cycle, and the industry and economic environment in which the entity operates. Entity's ownership structure, the way it is financed, again a factor. For example, an entity may be solely financed by debt rather than equity, wherein the users may put more emphasis on assets and claims on them. Okay. Relative volatility of the benchmark, again a consideration. Next, on the top of it, what do you do? Determine a percentage. Why? Because now the benchmark is selected. Now what do? You will now compute the amount in a way. So there's a relationship between the percentage and the chosen benchmark. Because if you remember, we looked at it. In case of PBT, your percentage range will be different. Revenue, it will be different. Total assets, it will be different. So you can't just have the same percentage range. Okay, so that again varies depending on the benchmark you select. Okay. Now this A part is a generic one. So if you answer this question, basically you are definitely having a case scenario, but this question is quite generic because it's all talking about the theoretical guidance which the standard provides. Now, as a next part, means part B of this question is specific to the case scenario. Yes or no? So now you are required to answer B1. When the company is engaged in manufacturing and sale of air condition. Further, company is having irregular profits. Now, see, this part becomes very important. There's consistency in profits. Every time we select the benchmark, please remember, PBT is always the first preference. I'm not saying this will be a by default thing. In the scenarios which support PBT. Okay. Now, if you look at B, in case ABC is engaged in construction of large infrastructure projects and incurred losses. Now, what do you have? Loss-making company in the previous 2 financial years due to pandemic. Can PBT be used? The answer is no. So that's why you move from PBT to maybe revenue or assets, right? Alternatively, auditor may consider criteria relevant for audit of entities doing public utility programs or projects. For example, total cost or net cost. That may also be the appropriate benchmark in the given situation. Right? Clear on this? See, every time when you answer such type of questions, please remember in the exam, irrespective of the weightage which is available, it is very important for you to give the rationale. You can't just simply say PPT and you are done. Maybe not into the details, but at least something you provide. Okay? Yeah. Next. New Life Hospital is a multi-specialty hospital which has been facing a lot of pilferage. Okay, so that's the problem. Facing a lot of pilferage and troubles regarding their inventory maintenance and control. On investigation into the matter, it was found that person in charge of the inventory inflow and the outflow from the storehouse is also responsible for purchasing and maintaining the inventory records. According to you, which basic system of control has been violated? Now, it's a very specific question because it is requiring a pointed guidance in respect of a particular system of control which has been violated. Also list down other general conditions pertaining to, so it's all about theory, but a specific point in relation to that system of control. Yes. Any thoughts, Saminathan, on this?
Yes, sir. As we discussed, the internal check is missing over here. The internal check which it talks about whenever there is a bookkeeping and accounting is done, it has to be done in the way in which is defined and implemented, wherein the segregation of duties must be there and the authorization of each and every transaction must be there. Also, the maker checker concept should be implemented. But in this case, it's very clearly said that the person who is receiving that the inventory records, the purchase, the same person is maintaining the inventory records, which is conflict totally on this system. The maker checker is violated on this. The SOD is missed on this part. Sorry.
Right. Now, in this case, the question is very specifically asking us about a particular system of control. Okay. Now, internal checks and internal audit are important constituents of accounting controls. Internal check system implies organization of overall system of bookkeeping and arrangement of staff duties in such a way that no person can carry through a transaction and record every aspect thereof. In the given case, now what is the problem? Person in charge of inventory inflow and outflow is also responsible for purchasing and maintaining it. There's one of the basic system of internal control, which is internal check, which talks about segregation of duties. The most important problem is about the segregation of duties in the given case. Yes or no? And which system could have taken care? Internal check could have taken care of that. Okay, right? Now, in the given question, we are also not only required to identify that. So this is already done. It's easy. You are also required to give the guidance around it. In a way, second part of this question. So let's talk about it, right? The general condition pertaining to the internal check system may be summarized as under. Wonder what is that? No single person should have complete control over any important aspect of the business operation. Every employee's action should come under the review of another person, right? So basically, if you talk about this control, it's nothing but the maker checker. Yes or no? Next, staff duties should be rotated from time to time so that the members do not perform the same function for a considerable period of time. Again, very important and very commonly you see this in case of banks. Yes or no? Every member of the staff should be encouraged to go on leave at least once a year. How does it help? Because the other person will come on that role and responsibility, and any wrongdoings, if at all there is there, can be identified in such a case. Persons having physical custody of assets must not be permitted to have access to the books of accounts. There should exist an accounting control in respect of each class of assets. In addition, there should be periodical inspection. Why? To get into the physical condition. Okay. Mechanical devices should be used wherever practical to prevent loss or misappropriation of cash. Budgetary control should be exercised and wide deviations observed, if any, should be reconciled. For inventory taking means physical verification of inventory, stock take. Trading activities, if possible, be suspended during that period of time when the verification is going on. Okay. And it should be done by the staff belonging to several sections of the organization. Financial and administrative powers should be distributed very judiciously amongst different officers, and the manner in which those are actually exercised should be reviewed periodically. Procedures should be laid down for periodical verification, testing of different sections of accounting records to ensure they are accurate. Okay, next. Let's look at this one. While assessing the impact of uncorrected misstatements in the audit of Mini Builders Private Limited, Mr. Gautam encountered a significant issue related to calculation of materiality on revenue. The initial materiality calculation was based on estimated figures provided by the management, which is fine. Management, to estimate full year revenue, extrapolated the sales for 11 months to arrive at a figure for 12 months, which is again fair enough. However, given the nature of Mini Builders as a company which is into the construction sector where the monthly sales exhibit substantial variations, therein if you extrapolate then the outcome may be wrong. Yes or no? Now, actual sales for the last month deviated significantly from the estimated sales due to unexpected slowdown in the project completions. As a result, last month's actual sales represented only 30% of the estimated sales. Now, Mr. Gautam is confronted with a dilemma regarding the appropriate approach to evaluate uncorrected misstatements using the previously calculated materiality. Now, in this case, you are required to guide Mr. Gautam. What do you do? Yes. Any thoughts, Saminathan? Any thoughts on this?
Yes, sir.
Yes.
Here, yeah, I think Gautami need to reassess the performance materiality in this case, since that is only the 30% of the estimated sales. Accordingly, he had to reassess and perform the audit.
Right. And why do you think such a sort of thing or approach is required to be considered? How does it help?
Because when you are reassessing the materiality, performance materiality is below the materiality is fixed. There, again, when we are reassessing the based on that only, it's represent only 30% of the estimated sales,
Right.
which means below the estimation.
Right.
So performance materiality also he has to be reduced down accordingly. Then
Okay.
only he can able to catch any material misstatement exist or not.
Right. Very good. So now, see, in this case, there are few important points for the consideration of the auditor. No doubt, materiality is a part of planning process. And if you look at the planning stage, generally you will not have access to each and every information, number one. And the information which is available may not be the final one. That's why it's a draft stage. Okay, so if you look at the given situation, what do you have? You have 11 months numbers to begin with, which have been extrapolated. Then considering the nature of the business, one may have to think through whether this extrapolation would have resulted in sort of unusual or maybe inappropriate outcome, which seems to be the case. Okay, which has actually happened. Okay, so that's why in this case, when you talk about the determination of materiality, that often relies on estimates of entities' financial results, no doubt, right? Therefore, before the auditor proceeds to assess the effect of uncorrected misstatements, it becomes necessary to adjust the materiality calculated under SA 320 based on the actual numbers rather than using the same sort of estimated. So you are required to, in a way, reassess that. And that's why we say that this reassessment is important and necessary. Now, further, if you look at the auditing standard, so it says as the audit progresses, what do? You may have to revise the materiality. This revision is prompted by auditors' awareness of information. Typically, significant revisions occur before the evaluation of uncorrected misstatement, which is important because eventually, when you are doing the conclusions, you need to have the right number in place. Otherwise, your entire conclusion will go wrong. Yes or no? Right? So, therefore, if the reassessment of the materiality under SA 320 results in a lower amount, auditor must reconsider performance materiality and appropriateness of audit procedures in terms of the nature, timing, and the extent, all of these factors. And this is important. Huh? Why? Because that will become the basis. for performing the audit procedures, and that will eventually give the audit evidence, basis which the conclusions will be drawn, basis which the reporting will be done. Clear on this? Yeah. So with this, we are through. And now I think any questions, any doubts? Okay, good to see Karuna ma'am is also here. Very good. So great. Over to you.
Any query of the students? Samyanathan, do you have any query?
Good evening, ma'am. No, ma'am. I asked all the questions during the class session. He answered each and everything in detailed way. Thank you.
Yeah. So, good evening, dear students. And today we have learned essay like engagement and quality control standard, section 1. Weightage is 45% to 55%. Very important topic, and Achal sir is making you all understand the question, how to answer, how to understand the standards requirement with the help of questions. He's making you all practice. I hope you are studying well and doing writing practice. Dear students, if you have any feedback, please feel free to share, because your feedback is very, very important. It will definitely help us to improvise further. And if you have any doubt, if you want to ask anything, do ask. And students, we have also started today fortnight program also. And for auditing, it is on 13th of March, 3 to 5 p.m. So I request you all to join the same, because in this session is purely meant for your success, right? So you all are requested to join the fortnight fortnight program on 13th at 3 p.m. for auditing subject. With this, thank you, Achal sir. Thank you, technical team. And thank you, dear students. Thanks a lot. Thank you.
Yeah. Thank you.
Thank you. Yeah.
Thank you, ma'am. Thank you, sir.
Yeah. Hanji.